That's the top, a toggle to the top of your Teams screen. We'll have a discussion segment after the main presentation where you will have the opportunity to have your questions answered. Now, without further ado, over to you, Jason.
Thanks, Damani. Good morning, everyone, and welcome to SCI's 9 month/third quarter financial results. As per usual, we'll start out by just giving some background to the context shaping the financial results. First thing I'd like to do is effectively highlight, well, this is a continuation from previous earnings calls, which is the earnings power of Accent. Key thing here is that when we look at the 9 month results for Accent, net interest income was 7.34 million, which represented a growth rate of 46.3%, which is a substantial growth for the 9 month period. More so for the third quarter itself, net interest income was 2.84 million, and with a growth rate of 71.4%. So what we are seeing is that net interest income is actually, the rate of growth is actually increasing on a quarterly basis for Accent. And in terms of how that translated to net profit, Accent reported 6.64 million in net profits for the 9 month period, which was up 47.6%. And if we look at the quarterly financial results, that would have come into 3.37 million in net profit for the quarter for Accent, which was up 127.2%. Again, reflecting an acceleration in growth, which is something that we would have said we expected to happen in terms of the continued growth path, given the excess dry powder that Accent has, and the fact that the Puerto Rican market is a $100 billion economy. So we, maybe a year and a half or so ago, we said that perhaps in 2 or 3 years' time, would expect that Accent would surpass SCI in terms of just raw earnings. And I think that that moment has kind of arrived, because as you'll see later, both the net profit and net interest income for SCI is actually now lower. Well, Accent is now generating more net interest income, more total investment income, because total investment income for Accent for the 9 months was actually 8.84 million. And as you see later on, that is higher than SCI's total investment income. So, we are in good stead, and the rationale as to why SCI went and acquired majority stake in Accent in 2022 has begun to, what I would say, bear fruit. In terms of return that SCI has been generating on Accent, and we are measuring this return since we did the reorganization effective July 1, 2023, is now 24.2%. I think you have gone ahead too far. In terms of total platform deployment, so if you take Accent deployment and SCI's deployment for the 9 month period, deployment is heading towards 100 million. So we're currently at 87.05 million. And based on transactions that would have been executed subsequent to the end of the quarter, we are squaring up on looking at 100 million in deployment for the financial year, which is a substantial contribution to the Caribbean region in just private credit space and what SCI is doing. Dividends paid to shareholders would have been, well, subsequent to the end of the quarter, another $1 million dividend would have been paid in April, I think on April 2nd, which matches the 1 million dividend that was paid in last year, October. And if you all recall, in October, well, on the last earnings call, when we were discussing that dividend payment, we had indicated that we had reduced the dividend relative to what it was the prior year, out of an abundance of caution. And so we maintained that cautious approach with the dividend that was paid subsequent. Well, I was declared during the quarter and paid subsequent to the end of the quarter. Of course, as you can see, based on the trajectory of how Accent is performing, how SCI is performing, and just the general macro environment that we are in globally, and also Jamaica, which is the second largest portfolio exposure, that caution, remains warranted. Of course, once we see clearer skies, we will adjust the dividend accordingly, especially given the fact that Accent has started to pay semi-annual dividends on a consistent basis, which we'll discuss later. Final thing here is that SCI's realized loss rate is still 0.2% over the 9.75 years of its history. Now, on the next slide, just to put this in graphical terms, you can see the net profit results for Accent, both on a quarterly basis, which is on the lower bar chart, and on a 9-month basis, which is on the upper bar chart. And we are showing you pre the reorganization and post reorganization. Now, the acquisition was done in February 2022, right? And the company wasn't making, from a net profit point of view, it was substantially lower than what you're seeing. So we just take the 1 year pre-reorganization, because the financial year end would have changed to June to match that of SCI effective July 1, 2023. So you can see that from the 9-month and 3-month result, it has been a consistent upward growth path. Now, jumping into SCI's performance itself, total investment income came in at 3.98 million, which was down 11.3% versus 4.48 million last year. I want to pause here for a moment because total investment income would have been affected by two things. I think on the last earnings call, we would have highlighted the fact that during the first 6 months of the financial year, we would have had roughly 20 million of exits, a large portfolio investment that would have exited, and it took us some time to reaccelerate the deployment of that capital. So because of that, we actually had a drop off in net interest income from the negative carry that we had, where we had cash that wasn't earning at portfolio rates of 13, 14, 15%, but we're earning cash rate of 2, 3, 4%, right? So we would have repaired that situation by the deployment figures that we have in the third quarter, which would have been around 15 million plus. But in the third quarter, we also had a situation where we had a one-time adjustment of 1.24 million recalibration to net interest income, and that affected total investment income. If you exclude that 1.24 one-time recalibration, obviously we would have surpassed last year's total investment income. The second point here is that the Puerto Rico investment income, which actually reported a new record up almost 100%, 98.9%, 1.78 million to 3.58 million for the quarter, reflected the record profitability of Accent that we showed you before. However, so that's a great positive, which helped out total investment income. Net investment income was 2.54 million, down 15.8% because of all the aforementioned reasons that I spoke about. And net profit, however, was 2.2 million, up 19.7%, primarily driven by the record underlying performance of Accent, which translated into record PRCF investment income. The earnings per share, 0.38 US cents versus 0.32 US cents similar quarter last year. And the dividends per share that was declared was 0.0017 relative to 0.0028, as we spoke about before. So that was a 1 million cash payment versus 1.6. On the next slide, for the 9-month results, you see total investment income came at 12.03 million, down 9%, versus 13.22 million. And again, the same things that I highlighted before for the 9-month period. So in the quarter, we had a one-time adjustment for 1.24 million, and of course would have been carrying forward the lower net interest income from the fact that we had the 20 million exit during the 6-month period. That was just cash sitting on the balance sheet effectively. That was then, obviously, it took us time to redeploy that, and we have redeployed out 15 million. In Q3, of course, we don't start earning. That deployment, we're gonna get the full effects of that in Q4 because we'd have gone one full quarter of earning that money, right? Similarly to the Q3 for the 9-month period, the Puerto Rico Credit Fund investment income notched a new record to 6.66 million, driven by the underlying performance of Represent. Of course, the 6.66 million is actually lower than it would otherwise have been because SAI would have received 1.01 million in dividend distribution from Accent in December, and therefore this 1.01 million went to offset the actual value of Accent to SCI. So this figure ceteris paribus would have been closer to 7.66 million, right? Of course, because we didn't have any dividend paid in the prior year, then this represents a fall off effectively from the prior year. But as we go into next financial year, this will normalize because next year, as Accent continues to pay dividend, ceteris paribus, we will have a dividend paying period compared with a dividend paying period. So it will normalize as of next year. Of course, as Accent make more and more profit, the dividend will be higher, but the difference won't be that great, right? And of course, we spoke about the fact that Accent made 6.64 million for the 9-month period of 47.6%. So net investment income, coming back to SAI, net investment income for SAI was 7.84 million, down 17%, affected by all the things that I spoke about before for the quarter and for the 9-month period in terms of the net interest income. Net profit was 4.85 million, down 30.4% versus 6.97 million for the 9-month period last year. However, this 4.85 million is actually higher than the full year financial profit that SCI reported last year. Earnings per share, 0.84 US cent versus 1.20 US cents. And we spoke about the dividends already. So moving to the next slide, which I won't go through in detail as usual, I just highlight a few things. So the first thing I want to highlight is net interest income. You can see for the quarter, net interest income came in at $372,493, right? And the big reason for that, as I said before, was the 1.24 million downward one-time adjustment that was made. Because if we didn't have that, the interest income would have been substantially higher. In addition to that, during the first 6 months, we would have been impacted by the 20.33 million of exits, all within a very short time period, which we weren't able to redeploy immediately after getting that cash back. And as I said before, we have redeployed 15 million of that during Q3, and we have actually deployed about, I don't remember, 10 or 8 million of that during Q2, but late during Q2. So the full effect of the redeployment of that 20 million we expect to see in Q4. But of course, we are more than likely will catch up with all of what we have, all of the lower net interest income for the first 9 months of the year by the end of the financial year. But we're not really concerned about that because this will, as I said before, on the last earnings call, will normalize as the AUM ramps back up from the capital that is redeployed. For the 9-month period, you can see 5.07 million was down relative to 6.7, and that reflected all the things I just said. Similarly, You can also see the Puerto Rico Credit Fund investment income, where the quarterly figure of 3.58 million, substantially higher than the 1.8 for the similar period last year. And then the 6.63 was higher than 6.23 for the similar period last year for the 9 months. But of course, both of these figures related to last year are 1.01 million lower because of the adjustment that is made for the dividend that SCI received. Now, yeah. Going down to impairment allowance, you can see that for the Q3 figure, it's substantially lower than at 167.5 versus 851 for Q3 last year. But on a 9-month basis, you see that is 1.44 million versus 1.27 million, and that reflected new stage 2 assets that would have been reclassified from stage 1 to stage 2 during the first half of the year, and therefore, as well as early preparation assessment for Hurricane Melissa at the end of Q1, and then also adding Hurricane Melissa exposures for Q2, and also a small amount for Q3. And final thing on the slide is you can see the net profit figure for the quarter, which is a new record. But for the 9 months, 4.85 million is down versus last year. But you can see in the financial year, June 2025 column, the net profit was 4.28 million. And so the 9-month figure has already eclipsed that. Now on to the next slide, where again, the next 2 slides, or next 3 slides are really focused on Accrescent. And we're continuously doing this because I want everyone to understand, just as we would have teed this up maybe 2 years now, saying that we expect Accrescent to really dominate once we execute in Puerto Rico. We expect Accrescent to actually dominate the FCI earnings, and that has started to occur. So what we are looking at here is for the quarter, Accrescent made 3.37 million, related to 1.48 million last year, and how that flows up to SCI, what is reported in SCI's income statement. So the holding company, which owns 100% of Accrescent, when you consolidate the 3.37 million into that holding company, with expenses in that company, the net profit came out to 3 million. But then once you go up to the next holding company, which is where the 95.9% ownership stake lies, which is what is get reported on SCI's income statement, that figure, based on market multiples, came out to 3.58 million, and that is what is reported in SCI's income statement. Similarly, for the 9 months, you can see 6.64 million net profit versus the 4.5 million last year. And that consolidated up to the first whole co translates to 6.1 million because you have account for some minor expenses, and then from a market multiple valuation approach that came out to 6.66 million. And that is what gets reported in SCI's income statement. Of course, the 6.6 million has already adjusted for the 1 million in dividends that SCI received in the December quarter. In terms of the dividend distribution to SCI, Accrescent is now paying semi-annual dividends to SCI, and it made 1 payment in December of 1.01 million, and subsequent to the end of the quarter, Accrescent would have declared another dividend of 948.7 thousand. So the total dividend that Accrescent has declared would have been 2.13 million, and that's between the second quarter last year and this quarter that we are in now, right? We have declared 2.13 million in dividends. And of course, SCI's share of that is expected to be 1.83 million. So we already got 1.01 million, the first dividend payment, and the second dividend payment we expect to receive 817.6 thousand of the 948.7 thousand that was declared. And that will amount to 1.83 million. So the second dividend, we expect to get that sometime this month, if not early next month. And of course, we would have highlighted many times before the fact that the figure that we are reporting in SY's income statement, the proof of the pudding will be when we start to get the dividend payment because cash doesn't lie, right? And so we are seeing already that in the first financial year of paying dividends, Accrescent is already at a pretty steep dividend level. That's 2.13 million in dividends declared. And this is the first set of dividend that is actually declaring. And the growth trajectory, you can see what the growth trajectory of the firm is, right? That the Q3 results are even better, and the dividends that were declared is not based on the Q3 results, right? So, we are in good stead as far as this company goes, and the effect that it will have on SCI on a go forward basis. Very quickly, now moving to the efficiency ratio, it came in well within the 40% threshold, which is benchmark against global private credit expense ratios. So we have been within this ratio now for the last two consecutive years in terms of March 2025, March 2026. So that's good news. It means that every dollar of revenue being generated, we are not wasting it. We are putting it back either in the business or it gets paid out as dividends. Similarly for management expense ratio, this came in at 2.3%, well below, substantially below the 2.85% threshold that we had promised to shareholders. From a balance sheet perspective, shareholder equity was at 76.02 million, mostly flat, marginal up 0.2% relative to 75.86 million for a similar period last year. When adjusted for perpetual preference shares, then total equity is 108.93 million US, which means that SCI has a pretty substantial balance sheet, which will allow it to navigate any type of economic environment that the Caribbean may throw at us. Total assets was 242.83 million, up 6.3%. And this total asset, of course, does not include the total assets of Accrescent, which is in excess, which is around 150 million US. So the private credit platform of SCI is pretty substantial and formidable. We intend to grow this substantially over the near to medium term. Of course, along with the balance sheet figures, SCI would have raised 28.38 million in capital over the 9-month period, and would have prepaid 7.91 million in notes and repaid 6.29 million in revolving bank credit lines, and would have also extended 26.99 million in preference shares that matured in December 2025 for 3 years, and we did so at lower interest rates. Balance sheet KPIs, everything is well within the portfolio manager's target threshold. So debt to total assets was 0.28 relative to the limit of 0.5. Asset coverage ratio, which speaks to how much assets we have on the balance sheet that can be converted to cash quickly to repay debt in a worst case scenario, is 3.58 relative to our target of 1.5. Higher is better. Net debt to equity was 0.62 times relative to 1.25 target that we have for ourselves, and relative to the benchmark limit of 2 times that the company is operating on. And non-performing investments ratio 0.3%. which is well within the 5% threshold level. Of course, we'll highlight the fact that we do have a number of stage 2 assets that we're working with those clients to help them get their business back on track. In terms of investment summary, investment in portfolio companies now stands at 226.69 million versus 214.63 million for the similar period last year. 41 investors versus 38 relative to last year. 15.33 million in investment commitments during the quarter versus 10.25 million. Fair value yield reduced to 15% versus 15.3%, and we expect the fair value yield to continue trending down, notwithstanding the fact that interest rates globally are perking up, but we think that based on the conditions, we think over the medium term interest rates are gonna the portfolio yield is gonna continue to trend down. Interest rates may pick back up, obviously, based on inflation trends, but Jamaica inflation trends are coming down, which is a large part of our portfolio. But we think that over the medium term, things will work them where interest rates the portfolio yield will gradually trend down. Average tenor 1.1 years versus 1.4 years. Dry powder 2.48 million versus 5.38 million, but this does not include undrawn credit facilities. In terms of action or activity that we are currently doing, we are advancing discussions with 2 international partners. One of them is substantially advanced. Another one, which we expect that any day now we can announce the closing of the transaction with the final CP in the bag. Working through a term sheet for another transaction. I know that I've been saying this like a stop record, but it is what it is. These things take a lot of time and diligence. I want to also highlight the fact that Accent would have deployed 55.72 million during the 9-month period. So the majority of the deployment that we spoke about earlier on the first slide was due to Accent, which obviously is a much bigger economy than all the Caribbean combined. We have 30 million in approved deals that are being documented to disperse. So obviously we're working through those. From a Hurricane Melissa update, nothing much has changed really. Total affected portfolio is 20.23 million, with 10.65 in the food distribution sector from 2 portfolio companies, 694,000 telecoms from 1 portfolio company, hospitality 2, 5.29 million, and manufacturing 1, 3.60 million. So this represented 11.1% of the SCI portfolio and 6.8% of the platform when it includes the Accent portfolio. From a balance sheet expected credit loss point of view, you can see where the ECL charge would have increased after the reclassification of stage 1 assets to stage 2. The way how this works is stage 1 assets, you use 1 year expected credit losses, which means that the amount of upfront credit impairment that you have to carry on the balance sheet, which gets translated as well through the income statement, is using a probability over a 1 year period. Once you change the classification to stage 2, we have to use what you call lifetime expected credit losses. And obviously, the expected amount of money that you can lose if you're estimating something over the life of the investment is going to be larger than it would be over a shorter time period of 1 year. And hence, that is what would have driven up the ECL to where it is now, as well as when Melissa came, we would have had to make additional provisions for the companies that would have spoken about on the previous slide. As well as the fact that as the portfolio grows, Obviously, as you put on more asset, you have to take additional provision, right? That's a part for the cost. But the main driver is really around the reclassification of assets to stage two, which we are renegotiating and restructuring those payment terms, as well as Melissa related charges, which we continue to monitor as we would have done during COVID-19 pandemic. So we have a playbook that we are utilizing, a similar playbook for the environment that we're in. In terms of allocation by industry, not going through this, you can see that SCI is just well diversified across 20 different industries. The top 10 industries account for about 90% of the portfolio. In terms of by region allocation, obviously Puerto Rico is almost 40% at 38.3%. Next is Jamaica at 24.9%. And as we go through time, right, this ratio, we expect that it's going to swing in favor of Puerto Rico. There are other Caribbean islands who could also start to challenge Jamaica to some extent. But we also expect Jamaica to hold its own because we are seeing tremendous amount of pipeline opportunities from portfolio companies in the Jamaican. Final slide. In terms of strategic update, the first and I would say most important thing is Accrescent in Puerto Rico is to continue to scale that business, and the scaling of the business requires additional fundraising, right? And that fundraising involves having equity / quasi-equity capital, which will then unlock additional revolving credit facility, which has worked beautifully for Accrescent, because when you have a revolving credit facility, this allows you to be very surgical and precise in deploying capital when you need to. So you draw down on the capital, you deploy it, and you repay it once you get repaid. So you don't have any negative, you're not paying interest on capital when you're not using the capital. Of course, SCI has that huge problem where we are paying interest on capital when we're not using it. We are obviously diligently working to get a credit line similar to what Accent has, but we have not crossed over that bridge yet. When we do, obviously, it will redound substantially to SCI's benefit. So we continue to do this because Accent's return on investment to SCI is I don't want to use the word phenomenal, is substantial. It's very high double digit, right? And you can see the deployment machine that exists in Puerto Rico since the reorganization. And you have already seen the level of profitability. And you're also seeing 2 million in dividends being declared, which is actually more than the dividend that SAI declared, right? I know that people are going to ask that question. So you can see that this is companies coming into its own. I expect it to that this is just the start. This is just the beginning, right? Yeah, so we expect to expand the credit line and explore further partnerships, funding partnerships to grow Accrescent in the Puerto Rico market. And the SCI proper side, we're in progress in terms of trying to move from 500 million, hit 500 million and then go to $1 billion in transactions across the region. We're on our way. Core revenues, which the threshold limit target was for 12.5 million. We're almost there in the 9-month period. So ceteris paribus, we expect to beat that target by the end of the financial year, which if we do, would ensure that the ROE of 10% that we are want to keep above each year will get there. So we're on 8.5% at 9 months, and hopefully we get there by the end of the financial year. We have one entire quarter to make up the gap. EPS, 20% annual growth. We are down 30.4% at the 9-month mark due to a lot of one-off adjustments. But let's hope if we beat the core revenue figure and the ROE, then we could also be in business for the EPS. But let's see. Dividends, that would have the APO price is now done at 3%, but the actual regular yield on the stock itself is at 5.6 as of March 13. Obviously, this has been affected by the 2 million in dividends for this financial year versus 3.2 for the prior financial year. But we have given justifiable reasons as to why we adopted a more cautious approach. And as you can see, based on the trajectory, we expect to, once the skies clear up, to adjust the dividend appropriately once financial support that. In terms of new business partnership, I would have stated already that we received business approval. So what we are doing now is moving through execution mode. We are a bit delayed on this. To be honest, we're targeting the end of March for the business to be up and running. I think we have to recalibrate by maybe a quarter, by maybe 2 quarters in terms of when the business will actually be up and running. So it's a delay rather than anything else, but the delay might actually be very beneficial. Of course, we have to continue to manage portfolio risk. We're in an environment where we have energy prices that are skyrocketing, costs are going up. We have a number of stage 2 portfolio companies that we are working with. Those principles to reorganize, restructure, help the business. We have helped quite a number of businesses through Hurricane Melissa in terms of new businesses that came on stream needing capital to take advantage of opportunities from Melissa. And we did quite a lot of that financing over the last 2 quarters, as well as existing businesses on the platform already that needed assistance, working capital support, etc., that we have also provided financial assistance to. So, having SCI as an alternative financing channel for businesses, particularly those who are hit by Melissa, is a good look for the entrepreneurs and the businesses who need to access more flexible capital. And final thing on share buyback, given the state of play that I just described in terms of caution with dividend payments, caution regarding to waiting to see how the unfolding of the stage 2 assets and the restructuring that we are helping those companies to go through, waiting for the dust to settle on those. Obviously, we have not done any buyback so far, but the buyback program still remains intact. At the renewal date, we will ask for renewal of the program. So the program is not going anywhere. It's just a matter of what's the best use of the capital. We actually purchased an additional 2 million in shares in Accrescent, right, in March, and that would have reflected the fact that we have great confidence in the business and how the business is going. So, rather than using that money to say pay dividends or to do buybacks, we use that 2 million to invest in a business that's giving us 24.2% return on investment. Of course, at the appropriate time, we will execute the buyback and continue buybacks as well as pay additional dividends to shareholders. But we just think that we're trying to set this company up for the long term, and we're at a critical path in the life cycle, given the inflection point where Accrescent effectively is now generating more net interest income, more total investment income, and more net profit than SCI proper. Although SCI did have some one-off things that affected it, right? So not to say that we are counting out SCI itself. It will come roaring back once we get past those one-off events. But you can see how Accrescent is moving from strength to strength. So the combined private credit platform that SCI is, when we think about what we are trying to do, you know, we are honing in on 500 million in AUM, and we are looking. The next stage would be to get to the $1 billion mark, right? And to get there, there are no more things that we need to do, and those things really revolve around the raising of capital, financing, which we have been diligently negotiating and speaking about for maybe a year and a half, 2 years now. And once we get over that hurdle, we are gonna unlock another level of growth and performance. That's the end of the presentation. I think we can take questions.
All right. Thank you again, Jason, for another detailed walkthrough. I'm sure listeners appreciate the clarity that you've actually brought to the performance and the context of which SCI, delivered its performance. Before we go to, we move on to the question and answers. I will just remind folks to use the Q&A toggle at the top of the Teams chat if you have any questions that you would like to ask, as well as folks listening on YouTube. Feel free to put your questions in the chat, and somebody will funnel it up for Jason to answer. I will just jump straight into some questions here in the Teams chat. So some folks joined late. They want you, Jason, to just go back over very quickly the reason for the interest income reduction, and also some more clarity on the one-off adjustment in interest income that occurred during the period.
Okay, so for both the 9 months, well, for the quarter, the interest income, maybe you can flip to the slide. That slides, I think it's slide 7, right? So for the quarter, interest income would have been affected by 1.24 million downward adjustment in interest income, which would have been an accumulation over a number of quarters, and we had to make all of the adjustments one time in this Q3, and that is a one-off item that then would have substantially reduced net interest income, because it would have brought down interest income from what would otherwise have been around 5.7 million relative to 6.1 million last year. However, in addition to that, if you recall, or if the person, well, let me just say, during the first 6 months of the year, in particular, during Q2, we would have exited $20 million from private credit portfolio companies that was generating a yield of around 15.5%, right? So if you take 15.5% on 20 million on average, that basically turned into cash, then we would have lost that in interest income in the quarter in which it occurred, from the point in which it occurred, as well as partially in Q3. So we started redeploying that cash in late in Q2. I think we deployed around 8 million or so of it. So we would have gotten interest income on like 8 million, but then for We deployed 15 million of that in Q3 at various stages during Q3. However, obviously, we would not have deployed out the 20 million from the start of Q3 to earn the interest income on that amount of money for the entirety of Q3. So the Q3 raw interest income is lower by the fact that we had this large pile of cash that was earning 2-3% for the cash that was on the balance sheet, as well as the fact that when we deployed it out, we don't have a full quarter to reflect. So those two items, when you combine them, the 1.2 million one-off adjustment, and the fact that we are working from a lower base in terms of the pool of assets that are generating on the asset side, because of that large exit, which means that we need time, and so when we get to Q4 and then Q1 next year, right, it will normalize. So by the time we get to a full 12-month cycle from the time that we would have redeployed the capital, it will normalize, right? Which is normally how any portfolio that has a high yielding asset that you exit, if you don't replace it instantly, then that's the effect. So that is what effectively affected net interest income, both for the quarter as well as for the 9 months period.
Thanks for that, Jason. Another question from listeners. SCI share buyback program ends in this current quarter, ended June 2026. However, SCI was far from hitting 1/10 of the program size. Even if the program is renewed, will SCI have available capital to deploy when the business is growing this fast and you're managing stage 2 assets?
A good question, right? And the answer to that question is yes, we will have enough capital. If you look at what we are doing and look at yes, we have stage 2 assets that we're managing, obviously. This is not the first time that we're going through that rodeo. But what I would say is that based on where we are, and given the pipeline that we have and the growth trajectory of the combined business, so when you look at SCI's private credit platform across both English and Spanish-speaking Caribbean, the trajectory for SCI is substantial. And so from a buyback perspective, obviously if the stock price remains depressed, there are multiple channels that we can use to solve that problem, right? But we don't want to do that in an environment where there is substantial uncertainty, A, and B, in an environment where the clear, obvious choice is to, before things get too expensive, buy additional shares cheaply, because we'll get the reward at the back end. So I don't think that there will be any issue with funding the buyback program. It's just a matter of choice, right? We are fund managers, we are alternative fund managers, and the question is, well, what's the choice that we want to make? Are we making a choice for short term or medium term or long term? And I think all the choices that we have made so far, in terms of the long-term benefit for the company to ensure that we can sustainably, religiously pay dividends, not just ordinary dividends, but also all other forms of dividends, right? Because SCI pays a substantial amount of preference share dividends to preference share investors, substantial amount of interest to bondholders, etc., right? And so we have to put all of that in the mix. And I understand the anxiety around, okay, what's happening to the buyback? Because the stock price is depressed. But we have to make as alternative investment managers, we have to split the hairs and make the right decision for the medium to long term. And at some point, that will also meet with the short term needs of, hey, let's execute a substantially bigger buyback than what we have done so far. Of course, we won't pre-announce that, right? It will just happen. So I don't have any doubt about the buyback program being able to be executed once the board approves the renewal. But as I said before, we have to ensure that we are being prudent around both risks and opportunities, because we have both stage 2 is a risk, is an opportunity. So we have to be very prudent about both of them in terms of use of cash.
Thanks for that answer, Jason. Question from the YouTube chat. Why hasn't the dividends from Crescent resulted in increased dividend payout to SCI shareholders? So perhaps you can repeat that explanation. Yeah.
Good question. I think I just went through it, which is we have to manage through what is a tough environment, or what can become a tough environment is what I should say, right? There are many risks on the horizon. Jamaica is almost a third. Jamaica is a quarter of our portfolio. The country was hit with a Cat 5. We showed you that we have 20 million of exposure to companies that were severely hit or have some substantial degree of hit, that we are working with those companies to get them back on their feet, right? So we are monitoring through that. We also have stage 2 restructurings that we are working through. And then we have the opportunity to use that same dividend that we get to buy more shares, for example, as an example, right, in Accent. So when we line up all of those three things, on one hand, we have to prudently manage risk. On the other hand, we should prudently take advantage of the opportunity that's sitting in front of us. We know the company inside out. We own 95 point something percent of it, almost 96%. We get an opportunity, then, you know, I think buying additional shares in the company using the proceeds of the cash that you get is very prudent, right? Because shareholders will stand to benefit substantially more than if I took that money and paid it out in cash dividend. Of course, the time will come, and hopefully that won't be a long time in the future, right? Where the dividend will just be like a pass-through. And so that would mean that the dividend that SCI itself is paying obviously would be substantially larger than 2 million that we are basically declared in this financial year. So that's how I answer the question. I don't want to say I'm asking for patience. I'm just saying that as an alternative fund manager, paying out an extra 2 million in dividend now, for example, versus or extra million in dividend now, versus reinvesting the money and then compounding because whatever dividend, the $1 million dividend we got and the 12-month, the financial year end dividend that Accent paid in December, right? When it's paying dividends on the June 2026 financial statement, we would own more of the shares, and therefore the dividend that will come to us will be higher. So I think that reinvesting the dividend into the company as shares and then increasing or enhancing the dividend in the future to shareholders strictly from a alternative fund manager point of view. We took that decision, and we think that that's the right decision for the long-term value creation of shareholders.
Thanks for that, Jason. I think the next question we could take in two parts. So the first one is regarding some clarification, and the second is mechanism/benefit. So the first clarifying question is the business approval related to the World Business Capital financing, or is that license related to different items? And the second follow-up question to that would be, in terms of the SCI sponsored dedicated investment vehicle, what is the mechanism? Is it that SCI would effectively invest in this vehicle to better raise capital to deploy to portfolio companies?
Okay, somebody's doing a lot of work, right? Two exceptionally brilliant questions. Let me take the first one. So the business approval is not in relation to World Business Capital. World Business Capital is the long heralded transaction that we were working on, where the Development Finance Corporation of the United States government would have been the guarantor under that program, which was stalled and has now moved forward, but there's just one CP outstanding for it to be finalized, right? So yeah, so it is not in relation to the business approval. Okay, so the sponsored dedicated investment vehicle, that is actually the business approval. And the question you're asking around, well, what's the mechanism? It's a good question. So the mechanism is, without giving away too much, SCI is the sponsor of the vehicle, which means that SCI is investing in this vehicle. It's doing so with a partner, and that partner is an international financing partner. SCI will also look to bring other partners into the fold so that the business can scale rapidly. And by scaling, I mean, when we're talking about SCI and scaling, we're really speaking in terms of substantial amounts of money. Yeah, let me leave it at that for the time being. And so the mechanism for SCI is similar to how SCI is invested in I guess in Accrescent, where we own kind of we are participating. It's not the same structure, right? But we are participating in a business. The underlying business can raise capital and grow and expand, and the net benefit of those AUM that is being deployed will flow back up to SCI. So it's not, to answer the question about is it a financing vehicle, it's not really a financing vehicle per se. I guess in a sense, anything that SCI invests in, ultimately, and that underlying investment is actually going to deploy private credit investment, you could say that's a financing vehicle. But to answer the question, this is not like a special purpose vehicle that is just a SCI feeder that is raising capital and channeling the capital into SCI. This is a proper standalone entity that SCI is sponsoring, and there are other partners that are coming to the table. SCI, of course, is going to be the main or a major financing partner, and therefore will get the main or a major amount of the of the net benefit or the returns that are generated from that investment vehicle. So that's how I want to characterize it. So it's not like a SPV where we put in $100 in SPV and then the SPV channel the money up to SCI and then SCI use the capital to deploy. No, it is the SPV for simplicity exists. SCI sponsors it, invests in it. Other people invest in it, and the net benefit, the net return. So let's like how Puerto Rico has a net benefit, net return, and you can see what the net benefit, net return to SCI is. Similar net benefit flow up to SCI, but not in exactly the same format per se. Slightly different, but very similar. I hope I've answered the question.
I think you have. Thanks for that, Jason. Flipping back to a Jamaica focus. So how much in new capital has been deployed into post-Hurricane Melissa demand? Also, with there being relative stress in the environment, do you expect to adjust more Jamaican portfolio, adjust more into Jamaican portfolio assets going forward?
Not understand. Oh, okay. So the total, I think the majority of the capital that we have deployed, which is about 15 to about 20-something million that SCI would have deployed over, say, the last 2 quarters, right? The vast majority of that is actually Jamaican companies. Almost all of it is Jamaican, come to think of it. And the pipeline that we have now with the 30 million in these that are approved and going through various stages of whatever, all of that, almost all of that, again, majority of that is actually Jamaican entities. And the environment that we are in, I think for the next 2-3 years, there will just be a lot of Jamaican opportunities, ranging from companies who are taking advantage of new emerging opportunities that would have arisen based on just the state and nature of what would have come out of Hurricane Melissa. There's a ton of reconstruction work across multiple sectors, service industries that there aren't enough service providers to provide the services that are required, right? And so people need capital, working capital, and that's what we are here to provide. There are asset-rich businesses that need financing, right? They have the assets, they need cash because there is a strong demand for their businesses, and so somebody has to come and provide that cash. And of course, we will collaborate with other persons to provide those cash. So Jamaica is just seeing a lot of activity occasioned by the hurricane, but also occasioned by we are seeing where fuel prices are very high. And even though that's generally bad for one section of the economy, that represent opportunities for other segments of the economy, right? In terms of demand and supply. So all of these things we are seeing, and as I keep saying, our main challenge is we effectively need like $100 million credit line. That's like, that's like if you ask me what I go to my bed wishing for, that's what I wish for. If we get that, then we can solve some real problems, because then we don't have this drag. We don't want to raise 100 million. We are paying interest on 100 million, and it takes 18 months to deploy the 100 million. It means that the trajectory in earnings per share is much muted relative to if I have a revolving credit line to fund it. And I just draw on it 3 days before it's going to be funded and then deployed. And once I've got back my capital, I pay it back and I repeat that process. So yeah, I hope I've answered the question that were asked.
Thanks for that, Jason. As a follow-up, can you explain the plans for more funding to support SCI's intensive demand? Has the company drawn down on its remaining credit lines after the quarter end?
Yes, so we have drawn and are drawing down on the credit lines. We have exits that we would have received additional exits subsequent to the end of the quarter that we obviously redeploying. So the beauty about timing of exit, sometimes you get the cash when you have transactions that are in pipeline but they're not quite ready to deploy, which is what happened in Q2, well, in the first half of the year, right? And then there are other times when you work through the transaction already and approve and the documentation is almost perfect. So by the time you get this cash, you basically can deploy it out almost instantly. So in this instance, that's what's happening. So that's also providing financing window. But we are also, constantly raising capital privately as well, right? Sometimes we make a big, sometimes, so when the capital is like a public raise, then we make a lot of noise about that, obviously, but then in many other instances, we are doing private raise and these are private negotiations. So we are doing a combination of private negotiations, which are ongoing. We have some of the international financing transactions, which we spoke about. One of which is extremely close. It has been extremely close since January, to be fair. There's just one CP that we have been waiting on, which I think it's fair to say could say that we have the CP is pretty much in place. We are working on another term sheet and advancing that with another international financing partner. So we are basically have a very diversified financing plan where we are tapping multiple sources all at the same time. And that's how we intend to fund the transactions that we have on the balance sheet. We also expect to get additional payouts. In the payout that we got subsequent at the end of the quarter, we expect to also receive additional portfolio exit amounts, perhaps before the end of the financial year, that will be substantial, that we can use to redeploy to fund these new transactions. So that's how we are treating it at the moment. We just have to continue plowing through until we get the financing over this financing hurdle, where we can be in a comfortable situation similar to our Puerto Rican partner.
Thanks for that, Jason. I have a few questions here from the YouTube chat, so I want to give them an opportunity to have their questions answered as well. So this reader has a two-part question. Notwithstanding, you would have gone through many of these items already. However, given the negative cash drag and the lower dividends announcements, amongst other announcements made recently, management fees are up. What is the explanation for this? And the follow-up would be, would you say, or would it be fair to say that management incentives are not aligned with shareholders because management fees are higher, regardless of net profit levels?
That's a very good question, and I'm happy that it was actually asked because it gives me an opportunity to provide clarity. So, stepping back, right? Management fees, the way how management fees are agreed between shareholders and the manager is we get a percentage of assets under management, right? And that is 1.9%, and it actually operate and at the scale. So, come what I would call hell or high water, whether costs are rising dramatically or costs are going down or they're flat, management fee is the management fee and it's based on AUM, right? So unlike other costs that you see in the management expense ratio, which are reflective of the inflationary environment or costs that you saw during COVID that obviously the manager has to face and bear, it doesn't matter. The agreement between the company and the manager and management is you get a fixed fee based on AUM. So your job is manage within that. So if the costs for the manager are skyrocketing, it doesn't matter. You have to live off that management fee. So that's the first point, right? The second point is, if you recall, when SCI started to show the management's confidence in the structure of SCI, three things happen. First, the manager outlined for shareholders a management expense ratio and benchmark that management expense ratio based on global best practice. That management expense ratio was 2.85%. So this is saying total operating expenses, which include the management fee and all the other operating expenses, shall not pass 2.85%. You need to keep it below that. That's the first one. The second one is, okay, efficiency ratio, which is the operating expenses divided by the rate of your revenue. That figure needs to be no more than 40%. And this is benchmarked against global private credit firms. So that's two. Number three, the first 6 months of SCI's life, the manager actually did not charge any fee. Let me say it again. So the first 6 months, the manager waived its fee. So let's bring all of these things full circle as to whether or not the manager is aligned with shareholders. A, the manager gave away 6 months of its management fee when SCI started just to demonstrate how confident it was that SCI would actually work. At a time when this was the first time anybody hearing about alternative investments and private credit and dry powder, all of those things, right? Gave that up. So that shows that the manager is well aligned. Number two, or number few, the operating expense ratio. You can see that for the current quarter and current 9 months, that actually came within the boundary or the targeted threshold limit that the manager agreed and benchmarked against global metrics. The management expense ratio, third point, you can see for the quarter and the 9 months, again, it came within the threshold. So that is how we get alignment with the manager and the shareholders of SCI in terms of management fee. Now, obviously, if the portfolio value falls because of, let's say, the manager doesn't do a good job of investing and loses a lot of money, then obviously the management fee naturally goes down. So the manager stands to lose if that happens, right? And because the manager don't want that to happen, the manager is incentivized to ensure that crystallized losses, realized losses are as low as possible. So since inception, what is the realized loss of SCI? It is 0.2% per annum, which is, I would say that that's an extremely low, and we hope, knock on wood, that remains. So the manager has a job. It is paid for that job. There are going to be ups and downs, obviously. Right? There are going to be times when SCI is delivering very, very high profitability. The management fee isn't up very, very high. Why? Because, for example, SCI has on its balance sheet companies that are structured with additional upside. Like, okay, if a company X is gonna do an IPO, SCI structured a note, or the manager structured a note for SCI, where if the company goes public, then SCI on top of the coupon that is getting, gets an additional premium, 10%, 15%, whatever, which goes directly into shareholders' pockets as, you know, I guess whenever that happens, it can be an extraordinary dividend or dividend that gets increased or what have you. So there are going to be these situations that occur when the management fee don't jump. But, you know, the agreement that we have is the agreement that we have. And our job is to keep management expense ratio low and keep efficiency ratio low so that we can take that cash and redeploy it into the business or give it to shareholders as dividends or invest it into another private credit such as Accent, right? And we have stuck to this. I mean, 1 or 2 times we have fallen out due to one-off instances, but in this reporting quarter, I think it's fair to say that given the lower crystallized loss ratio, given the low management expense ratio, given the low efficiency ratio, and given the fact that all the other costs that you see in the management expense ratio, which aren't tied to anything, they are just costs that exist, and if inflation drive up a particular cost 100%, it goes up. We have to bear the cost 100%. The manager has to bear whatever costs it needs to bear to operate his business. You have to live off the management fee. So from my perspective, I think it's fair to say, based on the track record of the manager, the sacrifices that the manager has made in the past, and no doubt will make in the future, it's fair to say that the management fee is very much aligned with shareholders.
Thanks for that, Jason. I'm hoping that listener got a clear and concise answer in their opinion. I'm not seeing any further questions in the Q&A Teams chat, nor am I seeing any.
One more point I want to, since there are no more questions, one more
Sure.
point, right? So there are times as well when, just to show alignment, right? When SCI raises new capital, which is cash, let's say SCI raises $100 worth of, SCI has a portfolio, SCI portfolio is $100, right? Suppose SCI goes out and raises $20 of new cash. In the period in which that new cash is raised and on the balance sheet, the manager actually does not charge management fee on that cash, even though the agreement says that we can, right? We actually exclude that calculation from the management fee because we want the cash to actually be deployed, so to speak. So let's say raised in the middle of the quarter, then, you know, next quarter we start when that cash pile would have been substantially reduced. So there are many things that happen in terms of what the manager does that follows best practice to ensure that we are aligned with shareholders. So I hope I've given a fulsome response to that exceptionally good question, because maybe some other people were thinking it and weren't asking. So thanks for that person for actually asking it.
Okay. Thanks again, Jason, for the clarity you provided. I'd like to remind listeners on the call that the recording for this earnings call, as well as the presentation deck, will be available on both the SYGNUS Group's website and YouTube page. A special thanks to you, or attendees and listeners. Thanks for the time, but thanks for taking the time, to listen to the presentation. you have any lingering questions, we encourage you to reach out to us via info@sygnusgroup.com or sci@sygnusgroup.com. And I'd like to wish everyone a productive rest of the week. Goodbye.